Hi, this is Paul. We're going to take our time a little bit to get started to give some other people a chance to get on. This is one of my favorite subject matters. The fact that we've moved a lot of assets and so a lot of life insurance did a lot of good for a lot of people. So we're just going to hold off for a couple minutes till some other people get on the phone. Hi, I see a couple of us are on this, and my friends are on this. We're going to start in a couple minutes. We give everybody about 3-4 minutes to talk, or actually to log in, excuse me. This is going to be on the concept of Insured Asset Conversion Trust. It's actually a follow-up on my last webinar on multiple policies because, once again, we are going to use two different things with this in order to make this happen. So with this in mind, give it just 3 more minutes. We'll start at 1:35. I've unmuted the phones of the people that are on it. If anybody has any questions before we start, you're welcome to ask. Anybody have any questions before we start? No? Okay. Cool. Heard something. That is, okay, we're going to get started. This is my favorite subject, Insured Asset Conversion Trust. I've been lecturing about this subject for about 20 years, and we have many different variations, but it has helped a number of advisors and producers to sell a lot of life insurance, create a lot of income for their clients, and have a lot of happy clients. So, do you have a client or a prospect that has their safe money? It may be in the form of a CD or a savings account or a treasury bill or annuities or even bonds, whether it's government, corporate, or muni bonds. And their biggest concern is not only the return on their money, but the return of their money. Further attributes of this person is they could be single or they could be married, and they're not necessarily concerned about estate planning. Actually, many seniors are not. And if they had a choice and it didn't affect their lifestyle, didn't affect their income, and they had a choice to whether they could leave the money to the government or leave it to Uncle Sam, they're obviously going to choose their family as opposed to Uncle Sam. So they would like to improve their net yield on assets, and as I said, after they've been taken care of, they can pass on more to their heirs than the government. And this whole exercise also reduces the taxable estate as well as giving the client more income and leaving more. And it could also insulate some of the assets from the long-term care providers with some of the new riders that are available in policies, both complimentary that come with it and also the ones that you pay for. So let's talk about the taxation of the insured asset conversion trust. There's two parts to this. The first part is an immediate annuity. And as many of us know, unlike a deferred annuity, an immediate annuity starts paying out immediately. And every payment that comes, a certain part of that payment is considered principal and some of its income. Obviously, the older you have, the older you are, the higher the principal amount, and so a lot less is included for taxes. They call this, when you're figuring this out, it's based on the exclusion ratio. The exclusion ratio is how much, when this is annuitized, is excluded from taxes. As we start looking at the people at 70 years old and older, we're starting to look at least 70%, if not more, is considered principal, and thus less than 30% to 20% of that income might be taxable. Upon death, we usually set this up with a life only, a life with 10, or joint and survivor. And so basically, the annuity, the immediate annuity, usually dies when the client dies, unless we've created certain circumstances. For example, maybe we did it on an older person and we wanted to do a 10-pay, so we did a 10-year cert in life to make sure the premiums are going in. But otherwise, that annuity, if it's set up right, it will die when they do. So if they put $1 million in it and they die the next day, their beneficiary, even though they might get $1 million from the life insurance policy we'll talk about, but from the annuity you get zero, and thus the government taxes as such. The life insurance, while they're living, as we all know, it could be a 4 or 5-way tax shelter vehicle. It's the next best thing to a Roth IRA, as the way FINRA reports it, other than it has life insurance costs. Because once you put the money in, it grows tax deferred. Income can be taken out tax-free if it's done the right way. Tax-free switches between different accounts. Let's say it's index accounts or variable accounts. You can switch the accounts without taxation. As I mentioned, tax-free income, and the death benefit, federal income tax-free. And if people are so concerned, there are ways of ownership where we can make the death benefit federal estate tax-free, but currently not a lot of people are worried about that because they think that the exemption of $22 million is going to exist forever, even though it sunsets in 2025. So here's how it works. The client purchases a single premium immediate annuity. They take some of that income on the standard insured asset conversion trust, the first one I'm going to show you, where I'm not trying to make more go to the heirs than the person. I'm just trying to return the asset. But they use some of that increased income to buy life insurance to replace that asset. And we also determine if that client is large enough that it really matters whether they own it or trust owns it or their children owns the policy. And we usually put either an ABR, chronic care, long-term care rider on the life policy because, as we said, we want to insulate it from the long-term care providers or needing care, how much that could take it. So let's talk about the effects when somebody does this. They don't outlast their money. They improve their yields on their safe assets. They pass on more to desired heirs. They can lower their taxable wage base to be lower taxes. Most people don't realize, but there's a number of seniors that aren't paying taxes on their Social Security because the thresholds, although very low for a lot of people, they don't meet them. And unfortunately, sometimes our counterparts put a lot of living benefit riders, withdrawal benefits, and they tell our clients when they start turning 65, 70 to take out the withdrawal benefits. Unfortunately, that's all ordinary income. Sometimes that could actually make their Social Security taxable. And we could take out more out of the qualified assets with this as well. So let's take a case study, a real study. We have a 70-year-old gentleman. He has children that are totally independent, and he's doing well financially. He's not really interested in life insurance or estate planning per se. He doesn't have long-term care because he heard all the stories about the premiums going up and people dropping, etc. And he has saved money that he just doesn't want to touch because he's worried. He's worried that he's going to land in that care home, or he's worried that something's going to happen. So he keeps that money around. Now, this client knows everything, as a number of our older clients. They've been pitched for annuities. They've been pitched for long-term care. They've been pitched for life insurance investments, and they know how much care actually costs because they probably have experienced it with either a family member or a friend, and it's not pretty. And they're independent living in attitude, and they would be too proud to usually call their children and say, please take care of me. Sure, we all have children like that. Mine aren't old enough yet, but I hope that they're much nicer when they get older. So what do you talk to these people about? As I said, they don't want to hear about the next best investment, the next best annuity, or the better life insurance and long-term care, because a lot of times they've heard that from other people in our business. He doesn't want to hear anything about the next greatest idea from you, and however, that prospect will give you a chance to talk. So how do we get them interested? I have a standard pitch I use. And if you think about it, most of our clients, their biggest concerns when they come to us are, one, outliving their money. In other words, running out of breath before they run out of money. Run out of money before they run out of breath. The second thing is if they worried about needing care. And only, as I said after that, if they've taken care of those first two, then they care about junior and junior S to take care of. So my pat saying is, if I could show you a way to increase your net after-tax income, guarantee safety of the payments, including keeping that away from the long-term care providers. In addition, when you take that very last breath, you happen to leave a lot more to your heirs, your desired heirs, than the government. Can we do business? Now think about that. Many people in our business talk about everything else other than being very direct. We're talking to them about increasing their after-tax income and not affecting the lifestyle and leaving more to their desired heirs and insulating from both Uncle Sam and the long-term care providers. So let's look at the psychology of the statement. We told them we're guaranteed income they can't outlive. That's very huge. I remember my father. I sold him, didn't even know what I was doing really when I was first in business. I sold him a single premium annuity when he was 65. And I felt bad because he put no contingency on for my mother. And I thought, oh my God, my mother's going to outlive him, which didn't happen. And even though my father was one of the greatest investors, every month he would ask me, Paul, when's that income going to end? When's that income going to end? Now, I was very lucky when I sold it to him because I didn't know as much as I so-called know now. But at the time, the SPIAs were over 9% with the interest function alone. So I locked that in, and finally, 4 days before he actually really did decease, he asked me again, when is that going to stop? And I said, Dad, will you take the last breath? And sure it did, when he turned 89 years old. But of course, he had collected over 24 years. He had beaten the system. We have three different ways that we can present it. Actually, we have multiple ways we can present this. But the three main ways that we solve for it is have somebody that has a net income for their lifetime and that they can't outlive. That's the first way. The second way is giving a heaped up income for the next 10 years and also making it a 10-pay for the life policy. That works very, very well. And the third is happening a lot is people are coming to me and saying, you know what, Paul, the people don't need any net income. So why don't you just not worry about income and use all of it to buy life insurance? In other words, no net income. So once again, 3 steps are we get a quote on the SPIA, we get quotes on the life insurance, and we get a presentation where we put it together, all the numbers, to make it in a presentable format. So when I send up, a lot of us use services that can do this spreadsheet that's listed here. This is a paid-for service that I use, and I shop out the SBIA. And as you can see, in this case, it's Connecticut, and somebody that's just turned 70, and you could see that I wanted. This is a life only, and there's no real guarantee of thing other than life only. I didn't put a contingency. You can see it's a big number that's coming out. Okay. Now this is just one of the software packages I do to shop the life insurance, and I can compare most companies that subscribe to this system next to each other so somebody could see. In this particular case, I was shopping out the least expensive for $250,000 of life. So let's go through the actual presentation again. I might have mislabeled because I said Mr. Sample 10 page, really Mr. Sample. So in this particular case, we take that $250,000, we buy the single premium immediate annuity. Of that, it will produce $19,286 a year of gross income. But of course, we got to pay taxes on that. So we'll pay $1,099 in taxes. And then to replace the life insurance, it costs a certain amount, costs a little over over $8,000. And in this particular case, the client is going to put over $10,000 in their pocket. So if we go through the numbers, we could see on the left side is just if they had the luxury of finding a vehicle that paid out 4%, and it shows that on that $250,000, 4% would be $10,000 at a 30% income tax bracket. They're going to pay $3,000 in taxes. Their net income after tax is going to be $7,000. So that net, if you divide 7 into 250,000, is 2.8%. Now, once again, I'm taking a yield that they usually can't get right now. I don't see many 4% out there without much risk, but I don't mind setting the expectations higher on the other side to show how much we can beat it. On our particular case, we took that same $250,000. The single premium immediate annuity gave out $19,286 a year. Of that, only $3,664 is taxable, so the taxes are $1,099. So before we buy any life insurance, we have $18,000 coming in the door. Now, in order to replace this $250,000, all we need is $8,000. So our net after tax and life insurance is $10,100, or for a net return of 4.07%. And that's after tax over 5.29. And I tell people, where can you get a guaranteed 4%, basically tax-free, because you've already paid the taxes and you already paid the life insurance for the rest of your life? You can't. You really can't. And transfers to the heirs. Now, I don't usually show a lot of presentations where somebody being preferred, but if they were so blessed to be preferred in this case, that same person would have had a higher yield of 4.58% because the life insurance cost would have gone down to $6,727. Okay, let's take case 2. The second one is, as I said, the client really doesn't care about net income. They care about how can they multiply that money, that saved money they have, and how they can get as much life insurance as possible. In this particular case, we took the whole $250,000. Since we're doing a 10-pay, we have gross of $28,683 coming in. Once again, just $1,099 in taxes. That's because of the exclusion ratio. But unlike just replacing it with a $250,000, we replaced it with $619,000 of life insurance that has a chronic care benefit. So with that in mind, if we go through the math, you can see their net yield after tax and life insurance is 0, but they're transferring $619,000 to their heirs tax-free, as opposed to that $250,000 that you would have had taxes, etc., on that estate if you had it. So there's other ways of setting up this joint and survivor. We have somebody on this call that approached me and had a particular lawsuit, and they had elder lady that had grandchildren, and in this particular case, they had a mother in between, and the grandchildren were the hurt ones. So they set up an estate for the grandchildren, or a settlement. And in this particular case, what we did was we took the money, and we took the older person, the grandparent in the 70s, who also was sick, and did the SBIA to do a 10-year certain in life. And then we did the life policy on the younger person, the mother of the children, for a 10 pay. And of course, by that 10 pay, it's going to have a decent bit of cash at the end of 10 years. So had the grandparent lived forever, they would have been paid forever and still have some net income. And had she deceased, that policy still would have been paid for 10 years, and the child has a net income, and as well as the children had a net income, as well as that spouse, that the child or the mother of the children could also get income from that particular policy. So it's a wonderful story. Another thing is using joint and survivor. Many people don't know, and they approach me and say, well, one of my clients is sick of the two. Why don't we just insure one of the two? And you won't believe it, if they're about the same age, a lot of times a second to die with one uninsurable person is less expensive than insuring the healthy person by themselves. And in that particular case, you could use a joint and survivor immediate annuity. So it happens on the second death. There's other variations where, let's say that person's really sick. Well, there's not a lot of them out on the market these days, but there still are underwritten single premium immediate annuities. And these are underwritten for the mortality of the person. So in other words, if the company recognizes and you prove, just opposite of life insurance, where you're trying to prove how great they are with the single premium annuity, trying to prove how bad they are, if you can prove to the company that they have a less of a life expectancy than the others, they'll provide a lot higher income. So once again, we can do variations of getting the higher income. We can combine it with a second to die with one uninsurable, but we can make it a 10 pay. There's lots of variations to this. Another big variation that we're getting a lot of mileage from is a number of people may not have it in their non-qualified funds, but they might have it in an IRA, or they might have it in an annuity. And I've seen a number of these annuities and these IRAs have living benefits. So the people are getting in their 70s. So instead of taking the worst asset to the Lord with them, their qualified plan or the annuity, because remember, nobody's ever paid taxes on that money. They're considered IRD assets, but they could actually get a higher income and do much better doing something like this. So these are some of the different ways of using the IACT, Insured Asset Conversion Trust. In many variations, it fits. One of the largest sales we had 2 years ago was we had an 82-year young person who had over $1 million in cash, and we did a great thing where the rep made over $600,000 on the transaction just because we were able to move all that money into an SBIA and part of it buying life insurance. It's a wonderful concept. So if there's any questions, I'd be happy to take any questions if there is any. I think there's a way to open it up. Let me see if I can open it up. Is there any questions, Bill? Hello? Anybody have any questions?
Paul, this is a full underwritten product, correct?
I'm sorry, you said, is the life insurance an underwritten product? Yes, it is.
Fully underwritten, correct?
Yes. Now, when you say fully underwritten, yes, it is fully underwritten, the life insurance. Yes, it's not a. However, there are some abbreviated underwriting programs if they're under age 70, where they may not have to necessarily give blood or fluids, but they probably will be not necessarily be examined, but they'll be talked to. So there are ways of doing it with that other type, but yes, it is underwritten, yes.
Excellent.
Any other questions? Anybody else have questions? Anyhow, I'm free to talk to anybody. My phone number, if you feel free to call me, is 860-761-1216. I tried to keep this brief under 30 minutes, and you might have specific cases you want to discuss, and it's a wonderful thing. And so I'd like to thank everybody that's on this. Thank you, and have a great day. Take care. Bye.